Goeiemorgen, dames en heren. My name is Heike Weidhase. As the CEO of the Efficient Group, it is my privilege to welcome you to today's session. May I please request that you mute your microphones and switch off your cameras and keep them off in order for us to have the best electronic experience possible, given the high number of attendees. Thank you for making this time available this morning to attend this session. We believe you will find this time well spent. We are all aware that today, the 16th of April, was supposed to be the last day of the South African lockdown, brought on by the COVID-19 pandemic. This is a significant date, as surely we all had expectations and plans of what would happen on the 17th and the days thereafter. For many of us, tomorrow would have been a day to celebrate, as we would have reopened our businesses. Schools would have reopened and life would have returned to what we consider normal. I'm of the opinion that South Africans have taken this crisis seriously and everyone has played a role in getting to grips and deal with what is happening in South Africa, but also across the world. I would like to thank everyone at Efficient and people connected to Efficient for the part they have played in dealing with this crisis. It is, however, so that the lockdown has been extended to, for now, the end of April. Every day will bring more facts, but also more noise and speculation. Our work at Efficient is to determine what the facts are, to get rid of the noise and speculation, and make decisions that are in the best interest of our clients and employees and the broader community. So how does Efficient break through this clutter? Simple. It starts with our name and ends with our people. Our name states who we are and what we do, and it's our people that make it possible. Since the first announcement to combat the spread of the virus was made on the 15th of March, Efficient people have given all they have to make sure that we continue to deliver to our clients. The efforts and results thereof include the following. No Efficient Group employee to date has tested positive for COVID-19. 95% of our employees are working from home with no or very limited negative impact on service delivery. We have been successful in continuing the administration, management, consultation and advice on more than 200 billion rands worth of assets during this time. We have implemented an active, ongoing and focused communication strategy to ensure that all stakeholders remain informed. We have successfully identified and communicated various initiatives to assist clients where possible with the economic challenges brought on by this crisis. We have stress tested and analyzed our group's financials to determine if there's any liquidity risk or other balance sheet risk that may need attention. We can confirm that there is no risk. Today's session is to brief you on what we believe are currently the facts and what investments decisions are we making that we believe are in the best interest of our clients. Our speakers today include Dawie Rood, our Group Chief Economist, who will provide us with the latest factual information on the crisis and the continued and expected impact thereof on economies. After Dawie, Pierre de Klerk, the Managing Director of Boutique Investment Partners, which manages and consults on more than 50 billion rands worth of assets, will provide us with a macro view, including current portfolio considerations. Pierre will be followed by Riaan Prinsloo, the Chief Investment Officer of Efficient Private Clients, who will talk to selected stocks and opportunities in this current environment. After Riaan, Deon Janse van Rensburg, the Managing Director of Naviga, our multi-manager that provides leading investment solutions to our clients, will focus on some important facts to consider when investing. I will then do a brief summary at the end of these discussions. Please feel free to email us your questions to info@efgroup.co.za. I will now hand over to Dawie. Thank you.
Baie dankie, Heiko. Baie dankie almal wat hier is. Good morning to everybody. My job is to see if I can give a bit of a background on what's going on as far as the economy is concerned. Heiko did mention that I'm going to provide you with certain facts, and unfortunately, being an economist, you don't always work with facts. because even the past is not always certain. So what I will be doing, I will give you a bit of a background and some of our estimates in terms of what we expect for the economy and some other variables that I think are very important. I'm going to start off by talking a little bit about politics. Clearly what has happened the last couple of days, and in fact the last couple of weeks, and in fact the last 2 months or so, is that the president has been acting really presidential. I think the image of the president improved quite dramatically the last couple of weeks, and it's very clear that the president is in charge. Unfortunately, what we've also seen recently is a kind of a comeback fight coming from the alliance partners, essentially the ANC. And the ANC is probably the ANC's biggest internal opposition, coming from the Communist Party, COSATU, as well as in from the ANC. So there seems to be a bit of a comeback. What I'm also a bit of a concerned about is that we are waiting for a final plan of cabinet, and they keep on postponing the date. The most recent date now is that we will get more information on Monday on what they plan to do in terms of the support to the South African economy and some other decisions that have been made and should be made. So we have to wait until Monday to get a better grip on what is likely to happen. Maybe it's just a comment about politics that I think is very important. We have to remember, if you give more power to bureaucrats and to politicians, they will keep that power. And even after the crisis, I'm afraid we will have a more powerful political elite in South Africa. And a very good example is the Minister of Police saying that he considers, and I'm only using this as an example, to extend the liquor ban even after the lockdown. Now, that's an example of a bureaucrat trying to keep existing powers. As things stand at the moment, the politicians and of course the bureaucrats like the police have a lot of power, and it's our responsibility as individuals to make sure they give that power back after the lockdown. Of course, the politicians are also talking about the restructuring. We can think about what needs to happen in terms of a restructuring of the South African economy, and I have many ideas of what I mean by restructuring of the economy. Unfortunately, I'm not sure that my ideas of a restructuring corresponds with that of our political leadership. One piece of information that I received is that restructuring in terms of our political leadership also includes the acceleration of the national health insurance. That's certainly not what I have in mind about restructuring. Fortunately, also, under these sort of circumstances, certain decisions are simply enforced on the politicians, and a very good example is what's happening to South African Airways. And it seems to me at last as if we have gotten rid of this huge destructive organization called South African Airways, and it seems to be on its way out. But again, there's no clarity on that. But at least the last demand from South African Airways for a bailout has been stopped by nobody else but Pravin Gordhan, one of the problems in actually this whole equation. So what's clearly happening, there are two inevitable conflicts that will happen over the next, and in fact, it's already happening. The first conflict is an ideological question. What are we going to be after the conflict or after the virus? Are we going to be more socialist, or are we going to be more free market oriented? But I think the important part is that we're probably going to have a weaker government after this lockdown. Another comment that I think is important making is that everybody's been talking about the fourth industrial revolution in recent years. And I think what we are seeing today is that the fourth industrial revolution is being forced upon us. We are currently, I'm talking to 300 people now, which is a huge privilege and an honor for me, but I'm doing it through a media that wasn't really known not that long ago. And everybody all of a sudden is using all this kind of new technologies. Our business is keeping going on as always, and I've never been this busy. So I think that's a very important point, but that also gives us an idea about the kind of sectors in the economy that will benefit from the future, from the fourth industrial revolution. One or two examples is obviously the sectors that will benefit will be the service industry, but not only the service industry associated with certain digital values that can be added. Exactly what we are doing at the Efficient Group as an example. So the financial industry will probably benefit from this. Industries like, for example, asset management and the like, but certain other industries that will certainly suffer because of the lockdown, and eventually because of the way that the economy is going to pan out over time, will be industries like, for example, manufacturing, generally speaking, also things like, for example, the primary industries like agriculture in certain instances, and mining as well. So it will be interesting to see how things going to pan out. Maybe we are learning as we go along. There are some interesting statistics coming from some other countries. A very good and interesting statistic coming from China is that even after they started opening their economy, is that people are still not buying or not buying that much. So I think we could see a drastic change in spending patterns of consumers once the economy has been opened up again. All those sort of things that we have to keep an eye on, and we certainly are at the Efficient Group. One or two estimates of ours regarding economic growth that can be expected over the next year or so. Of course, the South African economy will be hugely impacted by this. The estimates vary quite greatly. Moody's just sent out their estimates, which is a very modest contraction of less than 3%. The Reserve Bank expecting roughly about 6% contraction for this year. Our estimates is around about 8%, but it keeps on changing. Suffice to say, we're going to see a significant contraction. It's going to be very, very painful to the South African economy. According to our estimates, we can see unemployment going up by more than a million for 2020. And many, many thousands of small businesses will simply not reopen their doors again. This is going to be extremely, extremely painful to the South African economy. We have done various other calculations, like, for example, what can be expected on the fiscal accounts. We expect the fiscal deficit around about 12% of GDP. State debt levels will exceed 80% of GDP within the next 2 years or so. And the state revenue will collapse because of an economy that is under tremendous strain. We expect our state revenue in the region of about 200, maybe even 300 billion rand below original budgeted estimates. The reality is that there is no much fiscal space for the state to spend money, and we will see some projects, and I believe that Monday we will get more clarity on this. But the reality is we need 300 or 400 billion rand stimulus package in the South African economy. We just do not have the capacity for that. I know there's a lot of talk about borrowing money from the International Monetary Fund. That is certainly not an option. We in South Africa use rands, and remember, if you want to borrow money from, say, example, the IMF, you're going to borrow dollars, and if you want to borrow dollars, you must answer the question, what do you want to do with the dollars? What do you want to import? Or what foreign loans you want to pay off? And certainly we can import certain medical stuff as an example, but you cannot, there's simply no reason for us to go and borrow huge amounts of money from the International Monetary Fund. We have just concluded some calculations over the weekend. We have to remember also is that poverty also kills. The South African life expectancy is around about 60 years, while that of the Europeans is around about 80 years, and their income is roughly about 3 times higher than what we have in South Africa. The point I'm trying to make, certainly people are dying, and more people will die because of this virus, but a lot of people will also die because of an increase in poverty. And we must ask the question if we should keep the economy in lockdown, because that will lead to deaths as well. My view is that we should try to open the economy as soon as possible. I think the leadership, the political leadership made the right decision with information available, but what is becoming clearer by the day is that the South African economy is going to suffer quite tremendously because of this lockdown. An important point to make is that financial markets are always discounting the future based on the information available. That means that financial markets always react before an event takes place. And we've seen a huge contraction in the financial markets. The equity markets really contracting, and in fact, reacting quite volatile the last couple of weeks. We saw that all over the place. The forex markets, the capital markets, everything reacted quite violently as we get more and more information. So the financial markets trying to peer into the future to see what has happened. And the reason why I mentioned this is that financial markets are clever. Financial markets are always forward-looking, and I would really urge people not to take the unnecessary or hasty decisions in terms of your investments. Be careful. Financial markets are always forward-looking, and the financial markets will start rising. And in fact, we've seen some positive reaction on the financial markets because of certain stimulus packages, and financial market will start going up long before the economy starts growing again. So always keep that in mind. One or two comments about the South African Reserve Bank. The Reserve Bank, I think, acted correctly. Fortunately, we have a governor at the South African Reserve Bank that is rather conservative when it comes to monetary policy. He's been running a tight monetary policy ship the last couple of years, and he was criticized many times before, even by economists telling him that he's been running interest rates far too high and that he should be cutting interest rates. Fortunately, he did not do that, but now that we actually need that, unlike, for example, fiscal policy, we can actually use monetary policies to support the South African economy. And that's exactly what the Reserve Bank has done. And I agree completely with what the approach of the South African Reserve Bank at this stage. Interest rates have been reduced quite a lot. And surprisingly, we saw another 100 basis points cut, or 1 percentage point cut in interest rates this week. And it came a week before we expected another cut in interest rates. We expected this cut, but not so soon. I think it's the right thing to do, but the Reserve Bank has to be careful not to create the impression that they're starting to panic. The right thing to do is to cut interest rates, and I believe there will be scope to cut interest rates even further, but the Reserve Bank must always maintain a steady hand on monetary policy. So far, they're doing well. Just be careful not to overdo things in the short term. You may create the impression that you're starting to panic. The Reserve Bank are doing some other things as well that I think is the correct move. They've adjusted certain liquidity and capital ratios for banks, making it easier for banks to lend out money because it's easier for banks now to maintain certain ratios that are important for banks. Additionally, the South African Reserve Bank also decided to enter the secondary bond market. Now, that means that the South African Reserve Bank has started to buy government debt instruments in the secondary market. There's a so-called primary market. The primary market is where certain banks buy all new government bonds, and then they will sell it off into the secondary market. And the Reserve Bank decided then to participate or to also start buying bonds in the secondary market, and by doing that, providing more liquidity to the financial markets. The Reserve Bank is adamant this is not a form of quantitative easing, but I can tell you this thing walks a little bit like a duck, and it sounds a little bit like a duck, just maybe it is a duck. But we have to keep an eye on this. I think it's the right thing for the Reserve Bank to enter the secondary market. The real test for the Reserve Bank will be when they will have to exit that market, which must happen sometime over the next couple of months again. But we as economists, we keep an eye on that. And last month, for example, the Reserve Bank on a net basis acquired only 1 billion rands worth more of government bonds, which really isn't much. But if they do buy too much, I will start getting into that, and we will make sure that our clients know about that, and of course our investment teams know about that as well. One or two comments about the Rand and the South African financial markets that I think are important as well. Firstly, is that the South African Rand is a hugely undervalued currency, many reasons for that, and we can expect more volatility, especially once there's some rebalancing happening on certain international funds. So the Rand is hugely undervalued, which is important, and you will understand why just now. But it's also very important, South African bond yields are very, very attractive, and we currently offer around about 10% or so yields on the South African bonds. And even more important, South African financial markets are exceptionally liquid. The reason why I mentioned this is we have been downgraded by Moody's. When we see, for example, more stability coming back to the financial markets, foreigners and especially speculators will see that there's a very cheap entrance into South Africa by way of cheap currency. So the entrance is easy and cheap into South Africa. The bond yields are very, very attractive, and there's a lot of liquidity in the South African financial markets. And that simply means if they want to take a quick bite out of the cherry, they can do that in South Africa quite easily, which means I will not be surprised if we see a sudden and a relatively strong appreciation in the currency in the short term. Very much more volatility, but don't think the currency is a one-way bet. And the same goes for the bond market as an example. And maybe just one or two comments about what's happening internationally. We've seen massive stimulus coming from the various countries in the world, including stimulus from the fiscal and the monetary authorities. Interest rates have been slashed internationally. Various forms of quantitative easing have been announced by the various central banks internationally. And on the fiscal accounts, massive stimulus packages have been announced by the various countries. The biggest probably is coming in terms of monetary value coming from the Americans, obviously, but the Europeans are also also announced some stimulus packages. I think the important one in Europe is probably the Germans that announced certain measures to support their economies as well. There are some dangers, especially from Europe, for example, the Italian bond market. I think that's something that we have to keep an eye on. But without a doubt, the world is going flat out in trying to support the world's financial markets and trying to support the economies as well. But I think it's inevitable. The world economy is in a recession. The world economy will contract. Most of the major economies will contract, and quite significantly, I believe, this year. And there's even a possibility that the Chinese economy, which is expected to grow around about 1%, perhaps 2% now, but it's even possible that the Chinese economy may enter into a recession. So without a doubt, significant economic contraction can be expected globally. South Africa certainly is not alone in this. But I can assure you, my team and I, we keep an eye on all these various variables. I write quite often. And if you just, you can search for the Efficient Group if you don't get my research, and I will be happy to include you on our distribution list. Now, it's my pleasure with this. It's my pleasure to hand over to Pierre de Klerk. He's from BIP, and Pierre will give you a bit of a background on the way that he sees the world, and especially the financial markets. Thank you very much for listening to me.
Thank you very much, Davy, for the introduction. Just to make sure that everyone can see my screen. Seems to be all working. Thank you very much. I'm Pierre de Klerk from Boutique Investment Partners, and I would like to give you, following on what Davy has said about the economic side, I want to give you a bird's eye view as to what the macro considerations are that we are taking into account from the investment and portfolio management perspective at this stage, and what we feel we need to give attention to. So the first slide is the only slide that has words and text on. Thereafter follows a number of graphs. So this is really the high-level summary. And the first point to make is that after the crash that we had, risk assets are very cheap. Globally and locally speaking, assets are a lot cheaper than what they were at the end of last year before the market came off. SA equities are cheap. SA properties are also cheap. There are structural issues we need to discuss around SA property, but specifically SA equities on a 3 to 5 year view offer very good entry points and very good opportunities. And I'll illustrate that somewhat more. The second point is obviously the medical side around COVID-19, and from a markets or investment positioning point of view, the trajectory of that is going to be very important. And what do we mean by that? Basically, we need to assess and we need to learn as we go forward whether this is going to be a case of the global lockdowns working and the COVID epidemic basically being brought under control in a once-off through the lockdowns, or whether there is a risk of further resurgences and second and third or multiple waves of this. Therein lies the risk. And we have a reference point in that, which is the Spanish flu in the 1920s. So we're very well aware of what the risks are. We need to take that into account. The next point relates to what the economic recovery will look like. And we think it's going to be a U-shaped, some sort of a U-shaped recovery, which means, as Davy has pointed out, the next set of numbers from around the world is going to be terrible, frankly. In the US, the Q2 quarterly growth will probably be -15 if you annualize it. But then we expect some stability in the third quarter and then a strong recovery thereafter because of all the stimulus and the policy measures being thrown at this, as Davy also mentioned. So this, if we're correct, this is going to play out, as I said, in some sort of a U-shape over the next 3-4 quarters. But very importantly, the market is going to look ahead, and the market will sniff out, where the improvements happen and how the thing is developing. And we need to be acutely aware of that as well. The market typically looks 6 to 12 months ahead at least, and discount what the economic news and the reality is that is playing out. The next very important point is that monetary and fiscal stimulus around the world has been aggressive and it's been massive. Darby mentioned that. And it will have some effect. They've already put a floor under the functioning of the financial markets. So initially, when the market started falling, the concern was about liquidity and about the functioning of the financial markets. And through the various measures by the Fed, they have really ticked that box or addressed that. So they've put a floor under that. And there's interesting examples. You may have read that the Fed partly goes directly to companies, not through the bank system anymore. So now you have this unique situation where the Fed is prepared towards medium and small companies to act as almost like a commercial bank, and an unconstrained one. So it's quite different from the approach in the global financial crisis of 2008. The Fed is much more aggressive, and across the world, in Europe, in Japan, there is a lot being thrown at this problem. So from an investment point of view, if you think about portfolios, we must also be cognizant of the saying that says, don't fight the Fed, don't fight the wave of support and liquidity that is being thrown at this problem. Another few points, Darby mentioned this already, the Rand is cheap. In that lies opportunities. There also lies some risks if one rushes out of the country now with all your money, that the Rand might come back as it did after 2001 and do damage to your global portion of your portfolio. So we are very aware of that and take that into account. And then equities are cheap, as we said, but there are other asset classes that are also cheap, and SA bonds on a global basis stand out as offering very good yields, 7% above inflation that you can now lock in if you buy SA government bonds. So I think there's, and hopefully as I'll illustrate when you look at the graphs, there's positive things to take out of the response, at least, to the current situation. But lastly, and tying back to what Darby said, one must realize what the South African realities are. And that's a bit of a caveat. Our economic and our market prospects certainly have heightened uncertainty compared to developed markets and some of the stronger emerging markets. And that relates to our ability to cope with the pandemic. And we'll talk about that a bit, but it also relates to our fiscal situation. So one needs to be cognizant of our own realities, but I think also we are in a good neighborhood of emerging markets. And one possible play out of the global scenario is one where China, as a massive and significant player and contributor in the global economy, stimulates aggressively, come out of this first and drag the other emerging markets along with him. And therefore the South African ship rises on the tide of other emerging markets. So I think if one gets skeptical and gloomy about our domestic situation and the challenges we face, one must always consider that against the background of a much bigger emerging market complex of which we are part and which have very strong drivers in terms of big economies like China and the likes of Brazil when they get their act together. So that's the high-level summary, and now I'll color it in a bit for the next 10 minutes or so by reference to a few graphs. So firstly, just a market snapshot of what happened in the first quarter of this year. And this is the South African market, and I've circled there in the middle our year-to-date performances of our asset classes, mainly equity and the different sectors. And clearly the numbers were very bad. The market crash was fast and furious. It was a flash crash, and the first quarter numbers does not look good. And I purposefully did this graph to the end of March because this is the kind of numbers that investors will see on their investment statements that will be arriving from the LISPs this week and the week hereafter. So one can understand why investors might be concerned. But very importantly, the market has already had a bounce back, and the market bottomed around about the 23rd of March, and it's already up in excess of 20% from those lows. So it was a really fast movement to the downside, but once the Fed and the policy responses kicked into action and put a floor under it, there was a equally quick recovery. Now, one might be concerned that this is a classic dead cat bounce, and I'll talk a bit about previous developments of bear markets, but suffice to say, the question might be, what did we do in portfolios under these circumstances? And one thing that we didn't do was sell into this weakness and at the bottom, because when things happen so fast, when it comes, as the faster it comes down, the bigger the risk becomes for a snapback, even if it's temporary, and that's exactly what we've experienced now. So we would really guard against selling out at lows and locking in losses. If we turn to the medical side, there's just a few slides about this, and this is critical, as I mentioned, for us, because we need to position portfolios for multiple scenarios. The medical side around COVID remains uncertain, and that will have economic repercussions, and we must position clients' investments and portfolios to not bet on a single scenario. So it's critical for us to know whether this, the probability is that this will end in one wave, or whether there's risk of multiple waves. And the data comes in the whole time, and one needs to assess this. But the one thing we can say, and this graph shows the new cases up until the end of March across the world. And subsequently to this, if you read the news, you would know that in Italy, in New York State, the new cases seem to have peaked due to the more aggressive lockdowns that's been implemented. And there seems to be a plateauing in the cumulative cases as well. So one can take a positive view on this, or some positive aspects to think that it might well be that lockdowns work and we get this under control. Also, I think it's worth to mention that the response globally to try and find a solution of this have been significant, both in terms of financial means thrown at this, but also human ingenuity. So you might have read or know that there's currently 70 different vaccine projects on the go globally to try and find something that can resolve this. And there's already 3 vaccines in early stages of testing. So I think that again speaks to the fact that a lot is being thrown at this, and also to dealing with it. So firstly, looking for a vaccine, but also dealing with the impact of that. So it is also interesting to note how ingenuity just kicks in. Globally, GM, the car manufacturer, Tesla, the car manufacturer, Dyson, the vacuum cleaning manufacturer, they are all building ventilators now. They have repurposed some of their production lines to build ventilators, and in South Africa, Denel and Defy are going to start to do it, and they're working on a generic spec for a basic ventilator that they think they can produce 10,000 of them in South Africa by June. So again, making the point that there are significant responses to this situation. If we go on and conclude on the medical side, this is the other side of the coin that we need to be aware of and worry about. Well, not worry about, but think about in terms of a probability of what could happen in a worst case scenario, and position portfolios to also cover this. And what this shows is the Spanish flu epidemic in the 20s that really came in multiple waves because it wasn't brought under control in one shot. But I think one can be optimistic that the world has come a long way in terms of medical advances and so forth in terms of addressing this, but this clearly remains a risk and something we take into account when we think about defensive positions in portfolios versus more aggressive positions focused on the opportunities. This is the South Africa experience. We are the blue line versus the UK experience of infections in the orange line, and we have broken the trajectory, and it perplexes everyone. If you listen to the press conference by the National Health Department, there might be different reasons. It might be because our population is more resilient, because of TB vaccinations and antiretrovirals. It might be because our testing is maybe a bit behind, but it looks like we are backing the trend. We can't be complacent, but it looks like our lockdown is working and that we are having a positive impact on this. If we now move on to the markets and the economics, this slide shows how quick the response by the Fed was to support the economies and the markets compared to the financial crisis. The black line is the Fed's response in terms of the increase in their balance sheet post the financial crisis, and the green line is the response now. And as you can see, it is much quicker, much more aggressive. They are really throwing a lot at this. And numbers are coming in the whole time. This relates to the Fed's expansion of their balance sheet. But if you look at the total package of what will be done in the UK, initially they did 2 trillion of stimulus. That will go up. And I've seen research that said if you look through all the measures that they're taking, and I mean there's a list of 30 different things that they're doing, then it'll come close to $10 trillion, which is half of US GDP in a year. So a lot is being thrown at this, and one must think carefully if you believe this will not have a supporting effect for the market. As I mentioned in my summary, markets are cheap. This slide shows various markets, their PEs and their price to books. In the third and the second columns from the right, it then shows in what percentile of cheapness you fall as a market. And as you can see, if you look on the South Africa line, our market is now in the top 10% of cheapness over time. Or putting it a different way, we are only this cheap in our history 10% of the time. So markets are really cheap. If we look at emerging markets, same story. So this is the whole emerging market complex of which we are part, and emerging markets as a whole are cheap after the corrections. And we are part of this. Our assets offer good value, as does those of other emerging markets. We also mentioned our bonds, and if you just look at the graph on the left-hand side, it shows that our 20-year government bond now offers you a 7% above inflation prospective return, where typically over time it is supposed to offer you 2 or 3% above inflation. If you look at where the average by eye of that gold line over time is, it's around about the 2 to 3% basis. So for balanced funds, for example, like we manage, this is a really good opportunity to, alongside equities, also take positions in bonds, take advantage of these particularly good real returns on offer. Harvey mentioned the Rand, and for me just to reinforce that the Rand is very cheap where it currently is. And in that, as I said, is also a bit of a warning. If you look at 2001, which is in the middle of the graph, after 2001, where intraday the Rand got to 18 to the dollar and 25 to the pound, subsequent to that, it came down all the way. And had you rushed out of the country with all your money in 2001, you literally would have lost half of that through the Rand strengthening subsequently to that. So we also need to take this into account, and at the margin in portfolios, we have brought back a bit of money to guard against the risk that the Rand might strengthen. So what does bear markets typically look like? On this slide, the gray line is the current market fall that we experienced. The green line is the 1987 bear market, fall and subsequent bear market, and the brownish orange line is the 1929 market. Now, why this is relevant is because investors might take the view that they'll wait for more stability, and there might be a second testing of the lows as they were in 1929. Common knowledge is that the second fall in the 1920s was related to poor policy management by governments and policymakers. If you look at 1987, there wasn't really a testing of lows afterwards. So this is just to make the point that bear markets can have different developments, and it's not to say that what we've seen now since the lows is a dead cat bounce and we will turn around and test new lows again. It might happen, but one can't certainly bank on that. If you look at the green line, it bottomed in 87 and it was prolonged sideways, but it didn't collapse further than that. And it's also important to know when one typically makes money in a market cycle. And what this slide shows is post the market crash, over the next period divided into 10 deciles where you make the money. And what is interesting is most of the money you make, and it's quite intuitive, after the recovery. So the initial bounce after the market has crashed is typically very strong. Then there's a bit of a lull in performance. And then also interesting, in the very late stage of a bull market, when the party is at its red hottest, is also when you make outside returns. So psychologically, this is very difficult to deal with because straight after a crash, people are very reluctant to get back into the market. So they typically miss that first tall bar. And then right at the end of a bull market, as the news about expensive markets start hitting the headlines, people typically exit too early and miss that strong return at the end of it. And therefore, you might have heard that what is always said is that the average investor gets a much lower return than what the market gets. And it's because of this behavior of people due to emotional reasons being out of the market at the wrong time, exactly when the big returns manifest. So in summary, market timing and timing the bottom is almost near impossible, and we don't advise people to try and do it, and we don't do it in our portfolios. Investors also don't need to feel that they need to do something because you have portfolio managers like ourselves that you can leave things to, and we are not doing nothing. We are stress testing our models. We are relooking the structure of our portfolios. Managers are rotating out of companies that have dealt better with the recent environment, and they rotate to companies that maybe unfairly were sold down and now offer better opportunities. And us and other managers add to risk now so that we don't lose out on the recovery that comes. So those are the actions we're taking in portfolios. And what matters in portfolios is that we need to have a balance between the opportunities, which is clearly the valuations that are very good, and then the risks. And how does one do this? You position in the cyclical exposures, typically through the value managers, and that typically captures exposures to resources and financials, because if the economy recovers, that's where the big gains will be made. But one balances that with a bit of defense in portfolios, which typically is your quality exposures like consumer staples. And that, if the market remains tough for longer, will do better, because in that lies a bit more defense. So what have we been doing? We've been relooking our portfolios. We've ensured that there's proper style balance in this barbell approach that I described. And at the margin, we've added to the quality style or to the more defensive exposures. So we don't want to be out of equity, but we want to tilt it ever so marginally to exposures that will give us some protection in the short term. We've added bonds to portfolios and we've rebalanced back to at least neutral weights of equity exposures, again, so that we don't lag and are left behind as the market recovers. And then lastly, as I mentioned, we've brought some money back and certainly made sure that we're not in excess of the limits of what we can have overseas, because we think there is some risk that the rand can come back. So my key recommendation would be leave it to portfolio managers that are doing their jobs at this stage, stick to your investment plan, that is based on your risk profile. Medium to long term, there are very good opportunities offered by valuations where they currently are. The short term might be challenging, but we are deploying our mental skills and capabilities to deal with it as best we can and to focus on the longer term. Thank you very much for the time. I'm now going to hand over to Rian Prinsloo from Efficient Private Clients, who will color in a lot more at the individual stock level how they are approaching the situation. Thank you.
Thank you, Pierre. If you can just unshare your screen, then I can share mine. Thank you. Good morning, everyone. How's it going? Can everybody hear me? Can everybody see my screen? I hope you can. As Pierre mentioned, my name is Rian Prinsloo. I head up the investment team at Efficient Private Clients. Thank you so much for your time. I'm at Efficient Private Clients. We manage globally focused direct equity portfolios, and we really like this sort of thing. We really like speaking to our clients, and I think this is a great initiative, so thank you. Just going through what's happening and what we've been doing in our portfolios. I think a lot of market participants feel a lot like this. The market feels like this. Everybody, there's a lot of noise. We are in the pandemic, the biggest pandemic this century. And of course, there's big issues. We've had big issues before. You can say investors are a bit tired, but they're also battle hardened. We had a trade war, we had Brexit, and we've managed those. So just a disclaimer before I go on and just discuss what we like to do at Efficient Private Clients. We like our stocks like we like our socks, or as Warren Buffett likes to put it, he likes buying quality merchandise when it's marked down. And I think Pierre made an excellent case to why equities are cheap, both locally and internationally. I'm going to focus a bit more on the international side in my presentation. What our job is and what we do for our clients is we build a portfolio of the world's leading companies. It's not necessarily the world's biggest companies. It's not necessarily the companies that are growing the fastest, but it's companies that have a specific role they have to play in our portfolios, and that overall we can preserve and grow our clients' wealth. At the end of our investment process, what we look for and what we try to do is we try to build companies that have three characteristics and invest in companies that have three characteristics. The first is it's very important for us, for the businesses we invest in, to have a competitive advantage or an economic moat. That means that there's something within this company's business model which makes it, which protects its ability to make money. Microsoft, I think, is an excellent example. It's one of our core holdings offshore. But what we're seeing now is businesses would rather cancel their leases than cancel their Microsoft licenses. And I think that also speaks to how the world is changing. What's also important to us is we need some sort of structural growth driver. We want to invest in companies that are benefiting from global themes. Dawie touched on a few of those, but doesn't really matter what coronavirus does. The world population is going to continue aging. The world population is going to become richer, and we are also going to continue urbanizing in the coming years. And those are trends that we want to benefit from, amongst others. And then critically, what's important to us as well is we want that natural earnings progression within our portfolios. What that means is we invest in companies that can invest in themselves and are best positioned to capture the way that the world is changing. And I'm going to give a few practical examples of that in a moment or two. But first, most of our client engagements, our clients have been asking us, how were we positioned leading into COVID-19? I think the sell-off that we saw from sort of mid-Feb to mid-March, it was one of the quickest sell-offs in history. So nobody really expected COVID-19 to be this massive issue, which it turned out to be, and the markets reflected that. So there wasn't really much time to hide once the market realized and once investors realized what COVID-19 and the impact would be on markets. So I think that was out of our control, but what's in our control is our overall positioning in terms of sectors and in terms of underlying themes. In the healthcare space, what's important to us is to focus on and continue to focus on an aging population as well as growing lifestyle diseases. Especially in our portfolios, we own counters which benefit from outpatient care, so hospitals become under pressure. more people get medical treatment from their homes. That's a big theme for us, and we're also investing in some of the big drug originators. And with the recent sell-off, we've had the opportunity to actually increase that exposure. Davy also touched on it, but one of the big themes in our portfolios is what's happening in the tech space. We've had big exposure to cloud computing, we have exposure to 5G, we have exposure to AI, the voice-activated internet, and also online security. But what COVID-19 showed us is it basically bundled all of these themes into one, you can almost call it a mega theme, and that is from home. We all work from home, we live from home, we play from home, and that's really playing through in our portfolios, and we think our portfolios are very well positioned for that. In the finance space, what typically happens after an economic shock is you see this massive spike in savings rates. So when people get scared, they save more. A good example was what happened in the depression of 1929. Savings rates in the US, for instance, spiked from almost nothing to the mid-20s. And we are well positioned our portfolios for that by investing in companies like BlackRock, which would benefit from this rising savings rates as well as a potential uptick in global markets. So we like that, and we avoid companies that require interest rates to drive their revenue streams. In the consumer space, what I think is important is we focused on how the consumer environment is changing, especially in the entertainment space, especially with e-commerce. Amazon hit an all-time high yesterday. The reason for that we're going to discuss a bit later, but we like those sort of themes and we continue to invest in those companies. One theme that did hurt us a little bit, and we managed to exit that at what we think were good prices, was travel. The travel industry is going to take longer to recover. Also in the industrial space, we focus on delivery companies, we focus on companies with defense spending. Before COVID-19, geopolitical tensions were quite high. That is most likely going to be the case after COVID-19 as well, so that would benefit defense companies. And also what we are looking for is companies that play into the regionalization theme. Globalization basically peaked around 2016, 2017. One of the reasons was that labor in China just became too expensive. Then the trade war happened, and now COVID-19 really showed companies that you can't manufacture everything in Asia. You have to regionalize your supply chains, and your companies that focus on automating factory floors typically benefit out of that. So we are looking for opportunities in that space. In terms of property and other sectors, we actually avoid those because we think there's just too much risk in those counters. So our job is to cut through the noise, and there's a lot of noise in global markets. Markets are at the moment driven by two things: stimulus packages and COVID-19 cases. And we saw that even this week. On Tuesday, our markets were up. The reason was that there was massive stimulus packages announced last week in the US, and then COVID-19 cases hit 2 million, and then markets came back down again. So those are the big driving factors in global markets. But what's important for us is what are the underlying companies we own and that we invest in? What are they doing in these times? Amazon's a good example. Amazon plans to substantially hire more people. A couple of weeks ago, they employed 100,000 additional staff. Now they're increasing that by an additional 75,000 warehouse workers. Now that's a lot. That's 20%. That's a 20% increase on their warehouse staff, and we can see why. In Wuhan, in China, where the coronavirus broke out, we are seeing people are reluctant to visit malls. Mall occupancy, the lockdowns have been lifted, but mall footfall is still at approximately 50% of what it was before COVID-19. And it's not just in China. In the UK, for instance, a lot of apparel retailers were closed, but the apparel retailer Next, when they opened their website, they had to close it back. They had to close it after 2 hours just because of too much demand on the site. And that's a trend that we think we're going to continue to see, and we want to invest behind that. In terms of the financial space, as we've discussed, there's a lot of stimulus packages. What stimulus packages do in one way or another is it loosens financial conditions. When financial conditions loosen, what typically happens is interest rates and implied interest rates comes down. And we are seeing companies making use of this. Companies from Oracle to Nike are borrowing records amount in their in the investment grade bond market, and we invest in companies that benefit from that. We recently invested in S&P Global. They are the largest credit rating agency in the world. I think credit rating agencies sometimes get a bad rap in South Africa, but they provide a very essential service because they grade companies' debt and they ask a fee for that, and they are very important in the functioning of the financial system, especially in these times. And what we're seeing is investment grade issuance are the highest ever, even higher than before in 2013 when we had the taper tantrum and companies rushed to shore up their balance sheets. So we invest in the companies that lead in this space, but where we also can see their revenue streams going forward increasing. So that's important to us. And then finally, we also like, I spoke about earnings progression, but we also invest in companies where the companies are investing for their longer term future as well, because that's what's going to be important once we go through this crisis. One of the companies we own in our portfolios is Sony. Sony is one of the leading entertainment companies globally. They own everything from the Sony PlayStation. They're a big player in the movie industry. They're one of the biggest players in the music industry, and they're also a leader with their camera sensors. And those are, of course, very important for those all-important selfies. So what's good about Sony is they're investing in other avenues and revenue streams as well. They're investing $400 million into Bilibili. Bilibili is a Chinese youth-oriented entertainment platform. You can sort of think of it as the YouTube for Chinese youth. They started in animation. They moved into other areas as well. And they have already 150 million monthly active users. So it's a nice plug-in into Sony's entertainment ecosystem. So those are some of the companies we focus on. Those are the moves we are making in the portfolios. We are using this volatility. Just in conclusion, we like our stocks to our advantage. Volatility gives us the opportunity to really invest in great companies at great prices, and we will strive to preserve and grow our clients' wealth. Thank you for listening. I'm now going to hand over to Dion.
Thank you, Riaan. Just waiting for your screen.
Yeah, I'm going to do that now. Just having a bit of an issue.
Okay. Okay, good day. My name is Dion Jansen van Rensburg. I'm from Naviga Solutions. Sorry, it'll take a moment here to share my screen. Okay. Good day. I'm Dion Jansen van Rensburg from Naviga Solutions. We manage the unit trust portfolios for Efficient. So currently there's more than 1,200 unit trust funds in South Africa, and it can be a daunting task to select funds. So our role at Efficient is to analyze these funds and then to create solutions or portfolios that fits the needs of our clients. And we continuously manage and monitor these portfolios. So we've got a range of portfolios before retirement called the Naviga Saver series. That's for the accumulation phase before retirement. Then we've also got the Naviga Income series that's focused on post-retirement, your consumption phase after retirement, and I'll get into more details on what we do there. So before retirement, for investors that contribute monthly to their pension or a tax-free savings account, bear markets offer opportunity to earn higher returns. So this illustrates what happened in 2008 when markets fell by more than 40%. A client that invested monthly in that type of market scenario actually paid less for the units. So every month they paid less for the same amount of, for the same fund, they paid less for that fund. And when markets recovered, obviously they benefit from a low average cost of units. Someone that waited for the markets to recover paid a much higher price for those type of units. So they paid about 33% more for the units than someone that started to invest in a recession. The person that also started when markets recovered also have less units. Because they paid more for the units, they'll have less units in the investment account. So bear markets offer opportunity for debit order investors. So it's a good time to invest in a bear market if you're a debit order investor. But when it comes to retirement, it's slightly different. We follow a different investment strategy when it comes to retirement. So instead of investing only in one fund with all the asset classes, we split that fund into different silos or asset classes. And we only draw the monthly income from a short-term silo. So when markets fall, like it did during February and March, it wasn't necessary to sell units at a loss. So it was not necessary to sell those equities at a loss to fund the monthly income. We make provision for the income in the short-term bucket or silo. So within the short-term silo, we invest in flexible income funds. They're quite conservative. The target is to outperform the average money market fund. And we allocate about 2 to 3 years of income into the short-term silo. And the monthly income will only be drawn from the short-term silo. In the medium-term silo, we take slightly more risk. The maximum exposure is 40%. But the underlying fund managers should protect capital over any 1 year period. Then in the long-term silo, we invest for the long term. That's for long-term capital growth. We invest in equities and properties, and we use the same approach with efficient private clients. So we can replace some of the unit trust exposure with a share portfolio to get that long-term growth. So when we look at unit trust portfolios, equity outperformed all the different categories over the last 20 years. So the red line is the equity category compared to money market at the bottom, which is the solid blue line. And as you can see, there were times where equities underperformed in the early 2000s, equity underperformed money market. There was the financial crisis of 2008, and we had the more recent market crash. But despite all these recessions and bear markets, equity outperformed money market funds by a significant margin. And as you can see, as you increase your equity exposure from a pink line, which is low equity funds, to medium to high to flexible funds, the return increases. So the more risk you take, the more you invest in equities, the higher the return. Like our previous presenters also mentioned, is that bad news for economies can be good news for investors. So the highest return is achieved while the news is still bad. So, for example, during the last 2 weeks, markets rallied despite the bad news in the press or social media. So one must be careful to wait for the good news to arrive, because by the time the good news comes out, the market has already priced in that good news. So how do you manage portfolio in this volatile environment? So you diversify among different asset classes. We invest among different investment styles. So by combining different types of funds in different asset classes or type of investment styles, you get a much more consistent return by diversifying between these different asset classes or investment styles. We also diversify between different types of fund managers. We combine large managers, which are well known to the public. We also combine it with boutique managers that's smaller, but also more flexible. So in a volatile environment, they are more flexible to move between asset classes or stocks, and they can also invest in smaller companies that's extremely cheap at the moment. We also include index funds that reduce the cost of our portfolios. So the actions we take in the portfolios at the moment, in addition to the asset allocation that we do in the portfolios, the underlying managers also actively manage the asset allocation. They continuously assess their portfolios, do stress testing, and they also look forward to into the future to see which companies will benefit from this new normal after COVID-19. We're also tilting the portfolios marginally to the quality investment style, and quality companies should be able to withstand this difficult times. But when markets recover, you still want exposure to the momentum and value style, because those styles tend to outperform the quality styles when markets recover. But the quality investment style provides some protection in the portfolios. We're also increasing our SA bond exposure. SA bonds are extremely cheap at the moment, and we tend to go for flexible income fund managers that can manage the portfolio between cash and bonds. Cash went down to 4.25%, but at least from bonds, you can still get a 10% plus return. And where flexible income managers can actively move between cash and bonds to give a stable return to clients and still outperform cash at the bank. We retain our equity exposure. We're not reducing our equity exposure, and we're reducing our global exposure due to the weak rand. So to conclude, one needs to focus on the long term. Don't read too much news. Try and avoid social media. Don't panic. Warren Buffett said, be fearful when others are greedy and greedy when others are fearful. Stay invested. A loss will only be realized when the units are sold. And like I mentioned earlier, growth assets are required to give long-term capital growth. Timing is impossible, so don't try to time the markets. A study by JP Morgan illustrated that after the 10 worst trading days, the 6 best days happen after those 10 days. So the best days in the market tend to happen after the 10 worst days in the market. Our other study also showed that if you miss only the 25 best days in the last 6,000 days, your return would have reduced from 14.5% for SA equity to 8%. So a 50% reduction by only missing 25 best days in the last 6,000. If you miss the 75 best days out of the 6,000, your return would have been 0%. So it makes a big difference if you miss only a few of the best days in the market. So that's my presentation for today. Thank you for making time to attend the session. I'd like to hand it over to our CEO to conclude this session.
There we go. Let's quickly get the screen share. Thank you to the various speakers. Today's presentations and information will also be available via video. If you have any questions, please email them to info@fgroup.co.za.
Temporarily unmuted, it says, but nothing comes through, and then I'll get a message just now to say muted by host.
All right, let's go on. A brief summary. Despite the lockdown and the extended lockdown, the Efficient Group, its employees and advisors are fully operational, working in the best interest of our clients and available to be of service. Davy has provided a clear picture of the quantum of the challenges South Africa faces now and going forward. We as South Africans will have to support each other.
Nothing happens. And then I'll get this.
On the positive side, our government has surely created an expectation that they will deal with our many other challenges, including poverty, unemployment, crime and corruption, with the same passion and energy as they are dealing with the COVID-19 crisis. Pierre presented us with a summarized view of the macro investment environment, facts to consider with regards to portfolio construction, and, importantly, a clear and concise statement on actions being taken by him and his team with regards to our clients' investments. Riaan has pointed out that there are always opportunities. The difficult part is the decision-making, the decision to buy and sell. This can only be done if proper research has been done, which clearly their team is spending their time on. Dion confirmed what we all should know. Market corrections are buying opportunities. Also, it is important to be in a proper investment structure to start off with. We believe that currently, for investors, there is a fine balance that needs to be managed between good long-term prospects and the trade-off with short-term uncertainty and volatility. It is not unlikely that we will see further downward market pressure, but we can also not underestimate the impact that all the stimulus initiatives out there will have on various asset classes. It is with this in mind that our advice is to remain with your investment strategy based on your risk profile, and if your circumstances change, to discuss these changes with your financial planner. We thank you again for your time and wish you all the best. Goodbye.